Pau Morilla-Giner is Head of Equities, Commodities and Alternative Investments at London Capital, and he joins me now. Pau, thank you so much for joining us.
Pleasure.
You are very, very cautious about your investment strategy because actually you don't really want to touch anything, whether it be banks or equities, in these countries at risk. So where do you see value?
Value, as far as equities is concerned, has to be not really on countries that are definitely exposed to the domestic problems that the Eurozone has, but a lot of the global multinationals, perhaps based out of the US, perhaps based out of the UK, that have these very, very defensive and resilient earnings flow, that have very low leverage, good dividend and free cash flow yield, and most importantly, they have the indirect exposure to emerging markets growth. A lot of the small and mid-cap stocks within the Eurozone, and clearly financials being the prime example of that,
where you don't want to go,
completely
right?
out of the question. Not only because evaluations are not really giving you the very worst case scenario, but obviously because they're operating in an environment in which the politicians really ability to come together and try and put together a structural solution to the problems really does not going to happen.
So, in terms of these global equities that you would be willing to buy, resilient earnings, high dividends, you've mentioned the UK, but are there any specific stocks that look attractive here and also in the US?
Absolutely. There's a couple of sectors that really jump off the page, and within them we can talk very quickly. Consumer staples, very boring sector. Boring is very good in this environment. Boring means steady growth, and really not a lot of correlation to whatever growth will be. Yes, growth will be unstable in the US. Positive fiscal cliff probably will bring it down a little bit, but for as long as we have growth that's, let's say, positive in the US, a lot of these consumer staple stocks will be demanded. I'm talking about Procter & Gamble, I'm talking about Unilever, clearly not a US stocks, but I'm talking about PepsiCo. In the UK, we've got some very good pharma companies. Pharma is a sector that perhaps is not going to throw out double digits organic rates of growth, but
you won't lose money.
You won't lose money, and these companies have a lot of the cash really generation and cash stockpiles to really expand into where growth effectively is, which is the emerging market story.
And Pau, actually, last time you came on, I know you mentioned 3 stocks that you liked: Imperial Tobacco, Novartis, and that's interesting because it's another pharmaceutical company, and McDonald's. Now, they didn't all perform well, but they did perform better than the market in general. Are you picking also companies that are very high dividend? I mean, is this almost more important than resilient earnings?
As important. High dividend as important as a growing dividend. Just having a strategy where you just target high yielding stocks, it's just the very beginning of the solution. It's just not enough. You need to have really dividends that are not only high, that can be afforded, and there's ways to look at it, the dividend cover, etc., and that it's growing over time. And a lot of these stocks will be perceived as the safer havens within the equity space. Investors are sort of in a very schizophrenic situation. They want some equities, they need to have some equities, they have obligations, they have pension plan requirements and liabilities to fulfill, but at the same time they don't want to take a lot of risk. A lot of these stocks will be the safer havens of the equity space.
And Pau, you know, we were just looking at McDonald's. That stock was actually down some 6.4% since you last came on. You said it would be a good buy. Would you say, is this a good time to sell, or are you sticking with it?
I think McDonald's is as good as it gets in terms of this market environment. It has clearly the volatility that risk assets will have, but at the same time, it's very well run. It's growing significantly in emerging markets, and it's really giving you about 5.5 now dividend yield and a little bit less in terms of free cash flow yield levels in this market environment where capital gains will be difficult to find and growth cannot really take for granted. It's as good as you can get.
So investors should take what, a 1-year, 2-year view on these stocks, even longer?
I think investors, for as long as they take a 12 months plus view, they'll be okay.
They'll be okay. All right, Pau, thank you so much for your time. Pau Morilla-Giner, Chief Investment Officer at London Capital Group.